Hey everyone, thanks for tuning in to our August 2025 Investment Committee update. I'm Chad Smith, one of the managing partners at Reveille Wealth Management and part of our investment committee, along with the group that you see here. Today, Stephen Weitzel and I are going to share our latest market perspectives and how we use our rules-based investment discipline to inform the current positioning within our investment strategies. Markets performed strongly in August, helped by the prospect of additional interest rate cuts from the Federal Reserve at their upcoming September meeting. All major asset categories posted gains over the prior month, with the notable exception of commodities, which were led lower by falling oil prices. Initial estimates of annualized GDP growth for the second quarter came in at a positive 3.3%, rebounding from a 0.5% decline in Q1. However, the labor market continues to show signs of sluggishness, so the outlook for economic growth still remains uncertain. Signs of market rotation are more apparent, as leadership within the equity markets has been broadening out. We are watching for further evidence that this recent trend develops into a longer-term cycle. So I'll now turn it over to Stephen to walk us through this month's review.
Okay, thank you, Chad. So we're going to jump in and set the scene with a broad perspective on what's happening in the market and in the economy. So as we get started, I'll begin by saying that fall is one of my favorite times of the year. Hope everybody had a great Labor Day, but we're fortunately headed for cooler weather, beautiful colors, and the return of college football. So before the season kicked off here, I joined my friends Steve Straza and JC Peretz on the Stock Market TV morning show to preview the upcoming season, both the football season and the turn of new seasons maybe in the markets. And so we're going to begin with some of the charts that I shared with the two of them that morning, and we couched our conversation around the notion that perhaps these are some of the most important charts that investors should really be focusing on right now, things that they really should not ignore. And the first here is beginning with the Developed International Stock Index, which seems to have broken out of a 17-year consolidation period. So a secular bear market where no appreciable advance was made in price. That is finally resolved to the upside here. Now, so for comparison and reference, the S&P 500 made zero progress in price appreciation from March of 2000 until March of 2013. So 13 years worth of consolidation or secular bear market. And so those prior highs on the S&P 500 were around 1550. Well, fast forward 12 years later, and we're going to see that here in just a few minutes, we're going to see that the S&P 500 is around 6,500. So it's added 5,000 points since it broke out of that secular bear market back 12 years ago in 2013 after making no progress for over a decade. So the question is, what could the future hold now for developed international stocks, right? They've gone nowhere since before the financial crisis, but now they're starting this breakout, and this is a significant development, one that we've been waiting on for quite some time now. And so many investors have really forsaken investing in this space because the international stocks have been such a laggard over that period of time. But that might be changing. So far in 2025, the EFA index has more than doubled the return of the Dow Jones Industrial Average or the S&P 500. So could this be a sign of things to come? So for this reason, perhaps this is the most important chart in the world right now that investors should be taking notice of. But maybe it's this one. So the U.S. technology sector versus the broader S&P 500 index. So we've been outspoken for the last year and change about the heightened level of concentration that exists in the S&P 500 index in the technology space. Talked about it last month about NVIDIA, how large NVIDIA is, how it by itself is larger than entire sectors of the S&P 500. And so the S&P has not in modern history ever been less diversified than it is today. I did see a chart from Bank of America research recently floating around that showed that the only other time in the history of the U.S. stock market that a sector has comprised a larger percentage of the total stock market capitalization was back in the 1800s when it was dominated by railroads. It was close to 70% of the index at that point in time. But we look back in history and we can make note of a couple things. Number one, at that time, there were not nearly as many publicly traded companies as there are today. It was mostly railroads and banks and Western Union. So that was it. So the fact that railroads comprise such a large portion of the total stock market, it almost made sense. But we also know in hindsight now, over 130 years later, that was also a massive bubble in railroads. Go look it up. The Panic of 1893 and everything that had preceded that, a huge buildup in the railroad industry. But I digress. So the technology sector relative to the broader S&P 500 index, it has climbed all the way back to those former highs that the technology index relative to the S&P 500 soared to back in the early 2000s at the height of the tech bubble. Right? So we got back to those former highs. We got there the first time in late 2023, but we've encountered what I'll refer to as logical resistance there. But this cap, this resistance here, it's also occurring as we're witnessing what a technical analyst would refer to as a bearish momentum divergence, which is in this lower panel here. So, and as the name suggests, it's not really a positive development. It is a cautionary tale for sure that perhaps this is running out of steam. And if the largest component of the S&P 500 index begins to lose steam and falter, then it probably weighs on the overall index itself. So that's something that investors should be taking notice of. Now, what would cause the largest stocks in the market to lose steam? We could only speculate. It could be valuations, which are historically elevated. We've talked about that. Perhaps they start to miss earnings estimates and the growth targets that the market has imputed on them. Or maybe it comes back to an investor behavior that we haven't seen a whole lot of in a while, and that's maybe investors start to diversify a little more. So we saw at the top of our discussion how international stocks are starting to work again after going sideways for 17 years, right? So maybe now they're an alternative. Or maybe with the implementation of AI technologies or relaxed business regulations, maybe smaller companies in America can start to get moving again. They've underperformed the large cap S&P 500 index over the last decade to the point now where they are as cheap on a relative basis today as they last were at the peak of the dot-com bubble, right? So perhaps small caps are going to find their footing on a relative basis here at a logical level as well. And this time with a bullish divergence in momentum, which could be a fortuitous sign of things to come. But if this bull market in stocks is going to continue right now, the price trends are confirming that. We're going to see that throughout our discussion today, that all these things are in uptrends. But we still want to see rotation into other asset classes like small caps. So here's the last comment that I'm going to make here on the small cap category. and it's not to be predictive of the future, but just a data point from the past. Because the S&P 500, it has experienced long bear market periods before. And those too began with lofty valuations and positive, heightened expectations about the future, not unlike today. But as we discussed, from March of 2000 to March of 2023, we had a long bear market for the S&P where there was zero appreciable advance. But small caps, the Russell 2000 index over that same time frame, it doubled in value. So just because the S&P 500 might suffer, it doesn't mean that all hope is lost and that all aspects of a diversified portfolio are going to be down. Quite the opposite can be true. All right, let's move on, and we're going to start to look at some charts here of the key asset classes, and we're going to start with large cap U.S. stocks. The S&P 500 index is our proxy here, and we notice that it remains in an uptrend, new highs in the S&P. Mid caps, they too are in an uptrend, although we can see that they are actually still below their highs from last year. Small caps is the same story, right? They're back in an uptrend, right, following a pretty meaningful sell-off early this year, but they too are still below their former highs, right? So they did have a very nice month in August, however, up over 6% for the month. So even a little acceleration to this uptrend. Developed international stocks also remain in an uptrend and are still among the best performing stocks globally so far in 2025. Emerging market stocks also up nicely in August, around 3%. Emerging markets have been given a nice boost over the last couple of months on the backs of successful trade talks between the U.S. and China, India. So some of those deals, especially the one with China, remains still outstanding, hasn't been completely solidified, but they are making some good progress there according to the Treasury Secretary. So let's move to the bond market. The bond index, it remains in an uptrend, and as we highlighted in the preview, the employment picture in the United States is likely softening sufficiently to provide the Federal Reserve ample room to lower interest rates at their September meeting. And maybe we're going to start to see even more interest rate reductions going forward. Well, lower rates translate to higher prices for bonds. But we do think that the market is already moving to price in these future rate cuts from the Fed. So unless they say something to suggest that the economic outlook is more dire than the market is currently expecting, then maybe we're not going to see a large response from the bond market when we actually arrive at that Fed decision to lower rates. So the market already seems to be pricing in a number of rate cuts over the next 12 months. Call it 2 to 3 at least, and then maybe another subsequent quarter point reduction within the next 24 months based on the Treasury curve today. So again, bond prices have been inching higher. That's great, but we should not expect that we're going to see bond prices really move higher unless the market starts to anticipate that the Fed is going to lower rates much more, to a much larger magnitude lower than what they're already pricing in. All right, commodities have been moving sideways for the last number of months, so not much of a trend going on here, although maybe we're trying to see the whole asset class bottom at the same levels that it bottomed out back in 2021. Real estate too, kind of trendless, but given the fact that this asset class is historically sensitive to interest rates, if we see interest rates start to decline again, perhaps that's a positive catalyst for the real estate category.
Thanks, Stephen. So to recap, stocks globally performed well in August. continuing the improving trend in markets since the sell-off in the spring. All major asset categories posted gains over the prior month, with the exception of commodities. U.S. economic growth has been rebounding of late, with the initial estimates of annualized GDP growth for the second quarter coming in at a positive 3.3%. However, the overhang from ongoing uncertainty around global trade, plus clear signs of sluggishness in the labor market, are still a headwind for the global economy and markets. Signs of market rotation were more apparent in August, with improving performance from small and mid-cap stocks, along with value-oriented stocks. Going forward, further clarity around trade policy, the prospect for the Federal Reserve FOMC to lower short-term interest rates, and the potential for further deregulation from the Trump administration could all be supportive of the markets. As always, we will utilize our rules-based investment discipline to help us discern market trends that are unfolding rather than attempt to predict any particular outcomes. Stephen, some final thoughts?
All right, thanks again, everybody, for joining us here for this review. Hope it's been helpful for you. Hope your fall is getting off to a nice start. As always, if you have any questions or feedback for us, please feel free to share that with your Reveille financial advisor or send us an email to info@reveillewealth.com. Take care, everybody, and we will see you for the September review at the beginning of October. Take care, and we'll talk to you next time.